Hey there, and welcome. Today, we're going to dig into a question that's right at the heart of how businesses work. When a company makes a huge purchase, like a new piece of machinery or a whole fleet of vehicles, how does that actually impact their finances? Let's jump in. So let's just start with a quick thought experiment. Imagine your company drops $100,000 on a brand new, top-of-the-line machine. Does that mean your profit for the year just took a $100,000 nosedive? Well, the short answer is no. And understanding why is absolutely key to knowing if a business is truly healthy. Okay, so it all boils down to this fundamental difference between an expense and an asset. An expense is something that gets used up fast, like your monthly rent or the toner for the office printer. Its benefit is pretty much immediate and short-lived. But an asset? That's a whole different beast. It's a major purchase that's going to keep providing value for years to come, like a delivery van or that big machine we were just talking about.
To make this all crystal clear, we're going to follow the entire life story of a single asset, a delivery van. We'll start with why the purchase is a special case. Then, we'll figure out its true cost. We'll look at the difference between upkeep and upgrades, we'll talk about its inevitable decline, see how to calculate that cost over time, and finally, we'll see what happens when it's sold.
All right, first up, the big purchase problem. So the question here is, why is buying a whole van treated so differently from just, say, buying a tank of gas for it?
It's because our van is what accountants call a non-current asset. And this term is actually way more specific than it sounds. First, it has to be tangible. You can literally walk up and touch it. Second, it has to be used for more than a year. And this is crucial, its job is to help the business make money, not to be sold off to a customer.
Okay, so we've got our van, but what did it really cost us? In Section 2, we're going to see that the price tag is just the beginning. We need to figure out its official historical cost. Let's say the price on the window was $50,000. That's our starting point. It's what we shook hands on with the dealer. But the costs definitely don't stop there.
Here's the thing you got to remember. Accounting rules say that any cost that is directly attributable, meaning any cost you have to pay just to get that asset to where it needs to be and ready to work, gets added to its value. We're talking delivery fees, installation of special equipment, testing to make sure it all works, even professional fees tied to the purchase.
So you add all those necessary extras up, and suddenly, the real number that goes on the books, the historical cost, isn't $50,000 anymore, it's $55,000. And that is the number that we're going to work with for the rest of the van's life.
All right, the van's on the road, doing its thing, earning its keep, but of course we're still spending money on it. And that brings us to Section 3 and a really important distinction, upkeep versus upgrades. You can think of it like two different buckets for your cash. In one bucket, you have revenue expenditure. This is all the day-to-day stuff that just maintains the van. Fuel, insurance, fixing a flat tire. Those are treated as immediate expenses. But then, in the other bucket, you have capital expenditure. This is for the big stuff, the major improvements that actually increase the van's value or its ability to make money, like adding a fancy new refrigeration unit. That cost, it gets added right onto the asset's value.
So years are ticking by, the van's made thousands of deliveries, but let's be real, nothing lasts forever. It's time for Section 4, the inevitable decline. We need a system to account for the fact that the van is slowly but surely being used up.
And this brings us to the absolute star of our show, depreciation. Now, the most important thing to get about depreciation is that it has nothing to do with the van's changing market value, like what you could sell it for on Craigslist. It's a pure accounting concept. It's just a system we use to spread that $55,000 cost out over all the years the van is helping us make money.
So why do assets depreciate anyway? Well, there are a few key reasons. You've got the obvious one, usage, just plain old wear and tear. But value is also lost simply from the passage of time. Then there's obsolescence. Maybe a new, super efficient electric van comes out that makes ours look like a dinosaur. And finally, physical things like rust or heat damage can take their toll.
So if we have to account for this decline, how do we actually do the math? That takes us right into Section 5, calculating the cost over time.
Now, there are a few ways to calculate this, but we'll focus on the two most common. The straight line method is exactly what it sounds like. Super simple, you deduct the exact same amount of value every single year. The reducing balance method is a little different. It's more front-loaded, so you deduct a bigger chunk of the cost in the early years and less as it gets older.
And this table here just shows the straight line method in action perfectly. Let's say we decide our van has a useful life of 5 years, and at the end of it all, it'll probably be worth about $5,000. So we take our $55,000 cost, subtract that final $5,000, which leaves $50,000, divide that by 5 years, and you get $10,000 of depreciation expense per year. And you can see it right there. The value on the books, which we call the carrying amount, drops by a steady $10,000 every single year.
And just like that, 5 years have flown by. The van has served us well, but it's time for an upgrade. This takes us to our final chapter, Section 6, the final sale.
Okay, quick reminder. After 5 full years of doing its job and being depreciated, our van's official value on our company's books is down to $5,000. That number is now our starting point for what happens next.
So we put the old van up for sale, and we find a buyer who offers us $6,000, cash. We take the deal. The only question is, how do we record that sale?
It's actually super straightforward. We sold it for $6,000, right? But on our books, it was only worth $5,000. That extra $1,000 difference, we record that as a profit on the sale. Simple as that. Now, if we'd sold it for less than $5,000, it would have been a loss. And this perfectly wraps up the asset's life cycle.
So if you take just one thing away from all of this, let it be this. Depreciation is not about an asset losing its real-world market value. It's about an accounting system for accurately matching its cost to the revenue it helps generate over time. It's one of the most powerful tools for understanding a company's true profitability.
And that leaves us with one final, big idea to think about. If a company's assets are really its engines of growth, what does the way of depreciating them tell us about its strategy, its investment plans, and its outlook for the future? Something to chew on. Thanks for watching.